Then Latham and Watkins are going to go through the more detailed study in terms of structuring high-yield bonds within the context of an LBO transaction. So the first slide just looks at the growth of the high-yield market. I think many of you are probably familiar with this. The high-yield market, for those of us who spend our careers looking at it, has always promised very much, but to date rarely delivered, at least not until this year. We are seeing a degree of maturity in the market that hasn't been around before, and by that I mean a degree of depth, reliability, and cost effectiveness for a broad spectrum of borrowers, which is attracting a big resurgence in issuance this year. That said, I think there are plenty of reasons to be cautious. If you look at the high-yield market over time, you can see that in the past it has looked like it's on a steady growth path, only for it to fall flat fairly quickly. Going back to the late 1990s, the first real period of growth, driven very much by the emerging telecom sector, that bubble ended, as we all know, fairly spectacularly, leaving investors with significant losses, and it's taken us a long time to build confidence back in the market. Today, the latest growth over the last really 2 years was driven first by the fallen angel financing wave that we saw in sort of late 2002, 2003. But more recently, the issuance out of the LBO sector and the middle market corporates has really driven the market. And it's those three platforms, middle market corporates, LBOs, and the fallen angels, which has created the depth, which in itself has then fueled the investors to come into the market in a much bigger way. The other factor, of course, is the investor side of it. At the same time as issuers have started piling in, it's been made possible because of the growth of funds, both dedicated high-yield funds, to some extent banks, but also increasingly the alternative asset investors, principally hedge funds, who have been piling into credit product, which has in turn pushed the returns down and made the high-yield market far more attractive to issuers. And as we'll see shortly, what we've also seen this year is a lot more flexibility in how we structure high yields, be it with floaters, zero coupon bonds, and not just your standard non-call 5. And that flexibility itself feeds the growth of the market. No doubt there will be tests for the market as the credit cycle turns, as no doubt it will. But for now, we believe it's a very attractive time to be financing LBOs in the high yield market. If we We've jumped a few slides. Can we go back? Back one more. If we look now at the high-yield market in terms of what it has offered for the LBO sector, we can see historically LBOs have actually been a very small part of the high-yield market, the portion shown in orange. But this year, we've seen a big change in that and a significant growth. And then if on the next slide now, you can see in green, if we show the high-yield contribution to LBOs relative to the mezzanine market, we can see really for the first time in a long time, more LBOs are now being financed through the high-yield market than through the mezzanine market. And a lot of the new innovations, floaters, as well as the cost of high yield has been what is driving that switch really from mezzanine into high yield. If we look at it a slightly different way on the next slide, we show the mix of financing sources for transactions by a sample of sponsors that we've looked at. And as you can see, as you would expect from the pie on the right, larger deals tend to be where high yield is more often used relative to mezz, and as the size of deal goes down, mezz tends to dominate relative to high yield. Historically, that was always the case. The main driver of why people went to the high-yield market was the size of deals and the fact that the mezz market wasn't that deep. Today, it's not about size. We think you could easily do a €1 billion mezzanine transaction if you wanted, and that's large enough to accommodate almost all of the LBOs that we've seen recently. So it's not just about size that makes high-yield more attractive now. The main change in the last 2 years really has been the yield on high yield. And if we go to the next slide, what you can see is here this is the Morgan Stanley single B index in green for the US market and in red for Europe. You can see the peaks at the turn of the century where the telecom market fell out of bed and pushed up yields. But since then, the yields have come down dramatically, as I said, driven by huge investor appetite looking for credit product, coupled with a very low and benign credit environment, low default rates, and all of that has pushed returns for high yield down to the sort of 7, 8, 8.5% for your average LBO transaction. For an investor, those sort of returns, 7 to 10% with some capital appreciation, is very attractive relative to the equity market or the cash markets, and that's why, certainly for now, until we see a big change in the equity market, we think the investor appetite will be very strong for high yield. When we compare high yield now with mezzanine, the reduction in yields for high yield is what's driven this switch away from mezzanine into high yield, and it's very much a break-even analysis that most sponsors look at. If they're looking at an exit in anywhere from 2 to 4 years, historically mezzanine has been more attractive because the break-even, when you factor in the non-call cost of high yield, has been north of 3 years out, and most sponsors would plan to do something within that time frame. Today, even if you look at a traditional non-call 5 bond, the break-even is now just over 2 years when you compare mezz at roughly LIBOR plus 10 for your average mezz deal compared to a high yield at somewhere between 8 and 8.5. But what's more interesting on this graph is the development of the floater market. You can see from the bottom line in red, that is the cost to a company of a floater, and this graph is actually taken from the recent ATU transaction, which was the KKR led buyout in Germany, where they looked at the choice between mezz. They had a mezz deal initially in the buyout, and then they looked for proposals for high yield, obviously considered a traditional non-call 5 bond, but at Morgan Stanley we felt there was a huge appetite for floaters, and so came to them with a proposal for a non-call 1 floater. And when you compare that with mezz, which the call structure very much the same, but the coupon was LIBOR plus 725. So the cost effectiveness, when you start thinking about those sort of alternatives, it makes a dramatic difference. For investors, the floaters are very attractive in a rising interest rate environment. There's a lot more price stability in your average floater. It provides a lot more interest rate protection as well. But what I think is also important is understanding the mentality of investors today, that they are looking, the hedge funds in particular, for the shorter dated instrument. The constraint before has always been that your average high yield investor wanted to be locked in for 5 years, wanted a match fund, certain liabilities that the insurance companies typically had on their own balance sheets. The hedge funds like the liquidity, they like the flexibility of being able to switch out of an asset class very quickly, and for them a floater they view as being very correlated with the equity markets, because in their view the chances are that when the equity market starts to pick up, the floater will get called, they'll be liquid, they'll switch their money into the equity market, and that's exactly the time they want to get their money back. If the equity market doesn't pick up, the LBO is unlikely to IPO, and they'll continue to be invested in a LIBOR plus 700 piece of paper. So it's I think a relationship that we think works. Whether it will sustain if the equity markets do pick up remains to be seen, but the opportunity is very much alive today. So for jumbo LBOs, I think the economic argument is clearly compelling. There are obviously many other factors which sponsors will look at when deciding between mezzanine and high yield. Both markets are now very deep, very liquid, and it's really only the very, very largest deals that would only really give you a high yield option. Otherwise, it's a matter of looking at some of the, sorry, can we hold on that previous slide? Sure. It's a matter of looking at the trade-offs between cost, call flexibility, the public versus private disclosure, maintenance versus incurrence covenants, which Gay is going to talk to a little bit, and the setup costs, which are clearly more onerous for high yield, given the need for prospectuses, roadshows, credit ratings, and so on. But net-net, those factors lead some sponsors to have a natural preference for high yield, and some have a natural preference for mezzanine. On the next slide, one of the big factors that sponsors have looked at is the historically fickle nature of the high yield market. And if you look in Europe at the monthly issuance in high yield, you can clearly see there have been many periods where it's just not been open for high yield. Typically, those have followed particular events, whether it's 9/11, certain macroeconomic announcements or events, or periods of rapid issuance that have created a little bit of an overhang in terms of supply. But what it is true to say is that following these periods where the market's been shut, and they've tended to be very short, the market has always opened much stronger and come back in a better shape than prior to its closing down. So we've always told sponsors that the key is to make sure your bridge loan has the flexibility to ride through any period of closing of the market, because you should feel confident, especially today, that it will come back very quickly. On the next slide, a few comments in terms of bridge loans, which in any high-yield transaction is obviously key. Typically in Europe, and Gay's going to go again into some of the more details here, there are two main ways people think about bridge loans. One is a mezz-style bridge. The other is what we'd call a US-style bridge. The principal difference is really at the back end, whether you end up with a piece of mezzanine or a exchange note, which is really just a high-yield bond that is left with the bridge underwriters. How we get to that end point in terms of what the initial rates are, what the covenants look like, and the step-ups and the fee structure do vary marginally, but for a sponsor, the principal thing to think about is what do they want to be left with at the back end in the worst case that the high-yield market did stay shut for a long period of time or rates backed up dramatically. The good news is history would tell us that very, very few deals ever get stuck in a bridge loan, and it's not normally the fault of the market, it's normally the fault of the credit that we get stuck in bridge loans. So finally, I was asked just to look at the timetable. One of the issues clearly for high yield is the amount of time it takes, and that's another factor why it's important to have a flexible bridge loan. High yield bonds can be put together in anything as little as 6 weeks, but more typically would take around 10 weeks. A lot will depend on the degree of disclosure that there is already for the company. It is a transaction that takes a lot of input from a company, but a lot of that effort of putting the bond and the prospectus and so on together should be borne by the lawyers and the accountants and the underwriting banks. But the result, if you can, as with ATU, save over 400 basis points relative to the cost of mezzanine, is very much a case of short-term pain for a very much a long-term gain. So with that,
thank you very much.
Now that Simon has introduced the product and the market, it makes some sense to look a little bit more closely at what the product is. In terms of a quick overview of the product, a high-yield bond typically has a maturity of 10 years. It can have a maturity of 7. There are no principal amortizations. It is payable in full at maturity. Interest is typically fixed rate, although we'll talk a little bit about the fixed rate product, the floating rate product that Simon has been talking about. To the extent that it is a fixed rate instrument, it is generally not callable for 5 years, which obviously has an impact on cost of exit. It generally has a change of control provision, which requires a company to offer to repurchase it at a premium of 1% if and to the extent a change of control occurs. And the covenants are incurrence-based covenants. That is to say, there is no requirement to maintain any specific thresholds of financial performance. The only way you can really default a high-yield covenant is actually to undertake an action, to incur debt or to incur a lien. In terms of changing the market is the development of floating rate notes. These, in contrast to your typical fixed rate high-yield note, bear interest at a floating rate. They as well have no sinking fund payments, no amortizations prior to maturity. Their interest is obviously floating rate. The key difference between the floating rate instrument and the fixed rate instrument is that floating rate typically has a no-call period of 1 year and thereafter is callable at a premium. I think there have been a couple of deals done at 3-2-1 and a couple done at 2-1. And there's also been some done at 4-2. In terms of the remainder of the provisions of the instrument, they are by and large the same as a fixed rate high yield note. In terms of recent transactions, and Simon, you might want to comment on a couple of these as Morgan Stanley was involved in them. We have Elan, Ono, ATU, Telecolumbus and Cognis. I think, Simon, you were involved in ONO and ATU as well as Elan.
Elan, yeah. Morgan Stanley led 3 out of these. I mean, I think the one thing it demonstrates is you've got 3 very different types of company. You've got Elan, you know, as a corporate on very much on a recovery phase, ONO as a telecom company in growth, and ATU as a KKR-driven LBO. So again, demonstrating the high yield market is open for a wide mix of issuers in different parts of their development and able to structure different bonds to suit them. Elan was senior notes, and the other 2 were both subordinated notes. In fact, ONO was a triple C bond, so not only was it unusual in being a floater, but it was also extremely rare in being a triple B bond in a triple C bond in Europe.
Just moving to the structuring. So one of the things we were asked to talk about was what are the structuring issues? What do you need to think about when you're structuring an LBO and you're thinking about including high yield? I think it's fair to say that the tax, intercreditor, and other legal issues surrounding a high yield issuance are relatively complex. The key point, to the extent that you're contemplating using high yield to finance a piece of the transaction, is ensuring that you begin to think about the structuring issues at the very beginning of the structuring of your financing. It doesn't work to actually look at a high yield product after you've gone out and funded your senior debt. At that point, if you need to make structuring changes to accommodate intercreditor issues or market changes for the high yield, you will need to go out and get a consent from a possibly large syndicate of senior lenders, which historically has not been very successful. If we take a look in the next slide, there have been a number of French LBOs recently undertaken using high yield. Editis is the most recent one. LBC is a Lehman-led deal that was undertaken in May of 2004. Legrand, I think, at its time was the largest French LBO, and that was done in 2003.
Not just at this time, ever in France.
Pardon me?
Just the biggest LBO ever in France.
There we are. In terms of your objectives when you're trying to structure a high-yield bond, I think there are 5 main objectives that you need to think about. The first is that you need to ensure full tax deductibility of the interest on the high-yield bond. We'll talk a little bit later about some potential changes in French law that could impact how this is structured, but certainly you need to have full tax deductibility on the interest. Likewise, you need to ensure that all interest payments on the bond are payable gross without any withholding. Unlike the bank market where you can rely on treaty relief, that is not available for a high-yield bond. You need to be able to pay gross without any actions by the investors. Flowing a little bit out of one of Simon's slides indicated that there was a market shutdown about a year ago that arose out of a revolt on the buy side in the high-yield market. They were not satisfied with structures. By and large, historically, they had been structurally subordinated. They were demanding upstream credit support. The market did shut down. There was a fair amount of negotiation between the various constituencies. And I think we're now at a point where the two components, the senior side and the high-yield side, have reached a compromise. So at this point, it's fair to say that to the extent that upstream credit support in the form of subordinated guarantees are lawfully available, the high-yield market will expect them. The compromise and the quid pro quo from the senior side is to ensure that they are given adequate intercreditor protections to ensure that the high-yield investors are not capable of bringing the credit down before they ought to be. And the last issue, which is probably a lesser issue but one to focus on, is to ensure that the bond is structurally senior to any subordinated shareholder loans or subordinated shareholder equity that comes into the credit. We in the past have had difficulties with rating agencies when the shareholder equity has not been structured properly, and it's important to think about that at the start. As I said, just going to the next slide, it is now a fairly well developed concept that bonds are no longer purely structurally subordinated. They do benefit from upstream credit support, and they will get subordinated guarantees from operating companies where it's available. There have been a couple of deals that are purely contractually subordinated, but I think that's the exception rather than the norm. And just to give you an idea on the next slide of the movement and the change in structure. If you look at the Legrand structure, it's a little bit hard to follow, but basically the bond in Legrand was issued at the company called FEMEP. That was the company above where the majority of the bank debt had been lent, and certainly above where a significant portion of Legrand's outstanding debt sat. There was absolutely no upstream credit support for the Legrand bond, no guarantees of any kind. The only marginal support was a security interest in a downstream funding loan that went from FEMEP into FEMAP, which is where the banks sat. If you compare that to Editis, which was done recently, and I think reflects the results of the ongoing structural debates, in that transaction, the bond was issued out of a Luxembourg finance company with the proceeds loaned into the main bank borrower, so giving the bondholders indirectly a claim into the place where the senior lenders had lent. And importantly, there were guarantees from operating companies in favor of the bonds in Editis. Now, certainly there was not as much upstream credit support as the bondholders would have liked. Legally, we could not take guarantees from French companies, and therefore we were limited to foreign operations, which included Canada, Switzerland, and one other, I can't remember. But a relatively small proportion of the business, but it helped to be able to go out and tell the bondholders that they had guarantees from every place that they could have. Again, just a quick overview of the differences in structure. We've been through them. In Legrand, the bond was issued out of a parent company with no operating assets. There were no subsidiary guarantees, and the only security was a downstream loan, over the downstream loan. In Editis, we used a Luxembourg finance company. That is largely because of the favorable Luxembourg insolvency regime. There were parent guarantees from the French companies. There were, as I said, operating company guarantees that were subordinated. And I think another development in response to the structural debate is that there was second-ranking security over shares of operating companies held by the bank borrower. So while we couldn't take guarantees from the French operations, we did have an indirect claim into that through second-ranking security over the shares. Moving quickly through where we stand in the intercreditor debate, I think it's fair to say that the terms of upstream guarantees are fairly well settled between the senior banks and the high-yield lenders. Operating company guarantees are accepted. They are typically expected to have a standstill of 179 days. They are expected to have typical payment blockage provisions. So if and to the extent that there is a payment default outstanding on the senior debt, no payments can be made on the guarantees. If and to the extent there is a non-payment default outstanding on the senior debt, there's a period of 179 days during which no payments can be made on the guarantee. Another key component of this structural debate is to ensure that if and to the extent the senior lenders are in an enforcement scenario, so the credit has not done well and the senior are foreclosing on their security, it must be that the subordinated guarantees fall away, provided that that enforcement occurs in a way that is fair to the subordinated lenders. So we've negotiated a fairly standard set of terms which say that the guarantees fall away, provided that the enforcement procedure has happened pursuant to a public auction or there's a certification that fair value has been obtained. There are a couple of areas where we continue to debate with senior lenders. There is some debate about whether we or they, we being the high-yield bondholders, you can tell that that's what I do, should have the only security over the funding loan. So typically you've got your bond issued at a company above the bank borrower and the money is lent down to actually fund the acquisition or to repay mezz debt. Our view is that the bondholders should have the first-ranking security over that. The senior banks have security over all of the hard assets, and it doesn't seem appropriate to us to have the senior lenders have that. Nevertheless, we continue to debate it. We also debate if and to the extent that the bondholders do have security, whether that ought to be subject to the same 179-day standstill period as the guarantees. Again, our view is that that should not be the case. That is a loan that itself will have standstill periods, and therefore it's a mechanism whereby the bondholders can become direct creditors at the bank borrower level, and we ought to be able to foreclose on and take that loan as quickly as possible. In terms of share security, this is an area that continues to develop as well. I think there is a fair amount of debate over where the share security should stop. I think the senior lender's view is probably that the share security is really only a mechanism for ensuring that the bondholders are paid before the equity is paid. I think the flip side of that from the bondholders' perspective is that it is a means of ensuring that they are involved in any restructuring that occurs at the most likely place that the senior lenders might foreclose. So from the senior lender's perspective, the bondholders should not have any security from the bank borrower down. They should only have share security where their bond is issued or guaranteed. Our view is that, again, it ought to be second-ranking security that sits down where the bank borrowers have lent as well. If it is silent enough, it shouldn't impede the senior lenders doing what they need to do in a meltdown scenario. But it will, if they're not acting, give the bondholders the ability to force a restructuring or a workout if things have gone badly. Now, there are also just some unique issues to France, which I can let Etienne deal with. To the extent that you have second-ranking security over a French company's shares, because the high yield is issued second in time, it's not issued at the same time as the senior, some issues have arisen that we've been dealing with, and I'll hand it over to you, Etienne.
It was said in an earlier panel that the mezzanine typically gets second-ranking security because we have, how can I put it politely, an imperfection in the drafting of the French law on share pledges, which concerns primarily the Société Anonyme and the Société par Action Simplifiée, which would be typically the issuers or the borrowers of the senior debt, of the target. You normally, even for a MEDS, you will have a first-ranking security which is granted to the mezzanine lenders because you can't, or subject to what I'm going to say, it's much more difficult to get second-ranking security. Obviously, that's a problem. That's not a problem for the mezzanine. It becomes a problem for the high yield because you're granting security after the first-ranking security has been granted, and the only way you can get security is by getting a second-ranking security, or by asking the senior to release its existing security and to accept to be re-granted first-ranking security at the same time as the high yield. But somehow, if there are any bankers here, I don't think you would actually accede to that. Because we have a problem under French law, the only way in which you can get second-ranking security is to have to combine it with a mechanism of civil law called the tiers convenu. So you get basically a third-party custodian to hold the security for the benefit both of the first-ranking and the second-ranking. There's an academic debate, which I'll spare you, as to whether the tiers convenu is the senior lenders as a group, because that is what would tend to be indicated by one reading of the law, or whether it's actually the registrar of the shares through which the shares are held and who would accept to act as this tiers convenu. In Editis, on which we were involved, we went for the first option, where the senior lenders were actually all deemed to be holding for the benefit also of the high yield on a second-ranking basis. On another deal which hasn't come out yet, but some people might have guessed, where there's a high-yield refinancing, we're actually going for the second option for various reasons. In both cases, you actually end up with a risk factor in the offering memorandum. You end up with a reasoned, not a qualified, but a reasoned legal opinion from any French counsel that's asked to opine on this issue. We've actually found that the market does not have a problem with that. Obviously, they'd like a clearer situation. And what I'd also say is that we are actually leading, as a firm, Latham Watkins, a lobbying effort to get this law changed because it is absolutely nonsensical. The other point I really wanted to talk to you also in terms of security, shared security over the shares in the context of a high yield is the enforcement, because they both share security, even though on second ranking, on different ranking bases, they share security on the shares. You've got to agree on enforcement, who, how, when. It's not the same thing as allocation of proceeds, because in any event, whoever enforces and whoever gets the proceeds has to pay them over as part of the turnover clause. Typically in the US, the high yield would get no enforcement rights at all. In France, you would have three types of enforcement. You'd have something which is envisaged in our intercreditors, but it's quite theoretical. It's the idea that the shares on which you have security are listed, in which case you have quite a simple means of enforcing. That's unlikely to happen in our context. You can have an enforcement by an auction sale, and you can have an enforcement by what we call the attribution judiciaire, or which is also known as foreclosure, where you basically get the value of the shares attributed to you, the enforcer, by a court which determines the value of the shares, and then you have an agreement in the intercreditor as to how you're going to dispose of them, and then share the proceeds. There have been very few deals, as you know, where there's been in France an LBO with a mezzanine which has been refinanced by high yield. So I think it's a little bit difficult to say there's a market practice out there. We feel we got to a very satisfactory situation on Editis because we did obtain some quite unusual but quite strong rights for the high yield in terms of enforcement through foreclosure. At the end of the day, there is absolutely no case on the issue. Nobody knows, not a single lawyer knows how you would enforce foreclosure on the shares of the large companies that would be involved in a high yield financing. But I think it's still important to try, at least as far as the theory goes, to get it as right and as positive as possible.
Great. I think that will give you a fair view of where we are in the intercreditor debate. The short summary is that we're arguing over a far smaller number of things than we were 2 years ago, but there are still things to be decided around the margins. In terms of issues that might impact the way we're structuring transactions in the future, particularly French transactions, the one point that we can make is France is considering thin capitalization rules. They were supposed to be proposed this year. They were not. And at this point, I'm going to hand it over to Etienne to tell you what those might do. I think they impact both sponsor equity and
right.
high yield.
There's no thin cap rules on a corporate basis, but there are thin cap rules in terms of tax. And basically, when you are a direct shareholder, that controls the borrower, then there is a thin cap rule of 1 to 1 to 5 ratio, which means that if your loan is more than 1.5 of your nominal equity, then you have problems on deductibility of interest. That was not applied to French companies, because it was applied to foreign shareholders, so some people claimed that it was discriminatory. So France has been trying to rectify this. There were proposals which we received with other people involved to change that, and it would actually have made those rules apply to any person, whether you are a direct or indirect shareholder, and even if you're a sister company. And obviously that would be very detrimental to a lot of the structures which we put in place, whether it's a Luxco sister company which is lending the high yield proceeds onto Bidco, or whether it's a French company. Because there was such fierce resistance in the market, the proposals have been shelved, and we think they're probably going to come back in 2005 for implementation in 2006. And to be honest, we have no idea what the new proposals will be. And it's causing a problem because it will actually apply to all the structures which are in place, including the ones which were put in place before the law comes into effect. So we are already trying to structure around this in the transactions which we're putting in place now.
Great. I think with that as an introduction to structuring, we can do a very quick overview of what a high yield bond looks like and what the covenants do. One of the things I was asked to address is how do high yield bonds impact daily operation of a company, and how will they impact exit? I don't think we can talk about that unless you have a very quick overview of what the covenants look like, so I'll go through these slides relatively quickly. As I said before, high yield covenants are incurrence covenants. They do not have financial maintenance ratios. The most significant covenants are the debt covenant, the restricted payments covenant, the change of control, asset sale covenant, affiliate transaction covenant, merger covenant, and lien covenants. There is only one real affirmative covenant that impacts the company, and that is the reporting covenant. That requires the company to make information publicly available to ensure that there's a market for the bonds. In terms of the debt covenant, It is designed to ensure that the company doesn't incur debt unless it meets certain minimal financial health tests. It only applies when debt is incurred. It doesn't apply if your ratio changes without having incurred any debt. Historically, it just has not been practicable to have maintenance tests in high-yield bonds. On the next slide, the general rule is that an issuer cannot incur debt unless after the incurrence of debt, its ratio of EBITDA to fixed charges would be less than 2 to 1. The 2 to 1 can vary, but generally speaking, 2 to 1 is the test. In telecom deals, this is calculated on the basis of a debt to EBITDA test, often. There are exceptions to this coverage ratio, which is when you're negotiating a high-yield deal, what people mostly focus on because they're worried that they should be able to run their business regardless of what their coverage ratios are. Typical exceptions include a fixed basket for credit facilities, a fixed basket for purchase money debt, including capitalized leases, sometimes debt incurred up to the amount of new equity put into the company, intercompany debt, and then a general basket, which in general, you want to have a basket which is large enough to fund at least one interest payment on your bond. A couple of points to note. Generally speaking, capital markets debt is only incurable at entities which have provided credit support for the bonds. In terms of the calculation of the ratio, it is a looking back pro forma 4 quarters test. In effect, what you're doing is looking at the company's EBITDA for the last 4 quarters as a measure of the company's future ability to service debt. It is pro forma for acquisitions, dispositions, incurrences of debt, repayments of debt. So in effect, what you're trying to do is look at the steady state EBITDA of the company on the basis of the last 4 quarters. Ideally, the better calculation would be a projection of the next 4 quarters EBITDA, but given the unreliability of projections, this is the way the market tests the ratio. In these covenants, the keys will be to ensure that you've defined net income, EBITDA, and interest expense appropriately. For instance, in European LBOs where you have shareholder debt that comes in and is truly equity, you want to make sure that the interest expense associated with that shareholder debt does not count in the ratio. And if you're structuring covenants, you really need to sit down and look at the company's model and make sure that its operating business is accommodated by the covenant package. The next main covenant, and really the debt covenant and the restricted payments covenant are the primary protections that are offered to bondholders, is the restricted payments covenant. It restricts 5 things in European LBOs. The first is the payment of dividends. The second is the repurchase of equity. The third is prepayments of subordinated debt. The fourth is investments in non-restricted subsidiaries. And the fifth is payments on shareholder debt. The purpose of the restricted payments covenant is to ensure that the equity cushion which exists in the company, as well as future earnings, remain within the company to the benefit of high-yield debt holders. In general, the theory of a bondholder is that the company should not be paying dividends unless they hit their coverage ratios and unless they have adequate consolidated net income. They ought to be focusing on deleveraging rather than paying dividends. The basic rule in respect of restricted payments is that a company can pay as a dividend or other restricted payment 50% of their consolidated net income from the date the bonds are issued. So the equity cushion is split half and half between the equity holders and the bondholders. The company is also permitted to, in effect, dividend out any additional equity that comes into the company after the bonds are issued. The other prong of the test is that the company has to be able to incur at least $1 of debt under the EBITDA to interest expense ratio at the time that the restricted payment is made. Like the debt test, there are a couple of exceptions which are available regardless of the company's ratios. They are narrower exceptions than those for the debt test, as the common view is that there is not really a need to pay dividends, as I said before. These common Exceptions are repurchases of management equity. So if you have CEOs or CFOs who are leaving the company, everyone agrees that it's probably in the company's best interest to buy back their equity. That will be subject to a cap. Investments in joint ventures or non-wholly owned entities that are paid for with equity of the bond issuer. Acquisitions of entities that become subsidiaries. The view there is that to the extent that you're acquiring an entity which becomes a subsidiary, whatever cash flow that comes along with that is actually for the benefit of the bondholders. And then a general basket, which is typically quite small.
Yeah, I just want to mention a couple of things. I mean, obviously, these restricted payments and the exceptions to restricted payments are, we're looking at this in the context of an LBO refinancing, and obviously you've got the senior, and they're probably going to have fiercer restricted debt payment obligations at the same time, so which are going to override the high yield ones. And the other thing is, obviously, every deal will have its specialities or its exceptions. For example, in Editis, what we discovered was that it's an area where a lot of the payments, which in other areas might be done through just commercial contracts, are done through sociétés en participation, which are actually companies which are not notified, or the existence of which is not notified to third parties, where the payments are actually done by way of a certain sort of, it's effectively a payment of dividends, and that obviously had to be carved out in a particular way to allow the company to continue operating in the usual way.
Okay. The next covenant that I'll go through in detail, and I think I'll just whiz through the rest of them, is the change of control covenant, just because it obviously has an impact on exit. As I said before, typically, to the extent that a change of control occurs, the issuer of the bond will be required to offer to repurchase the bonds at 101. Sometimes the change of control covenant also has a second trigger, so a change of control has to have occurred as well as a ratings downgrade having occurred. I would say that the ratings downgrade component is probably available in 30% of the deals. I don't know, Simon, what do you think? If that?
Probably less for an LBO,
Yeah.
very few LBOs.
The key aspect of the change of control is that the bondholders have bought into a particular sponsor and business plan, and if and to the extent that that changes, they ought to have a chance to take a look at the new credit and be taken out if they desire. Okay, just going through really quickly, the asset sale covenant basically requires that certain amount of cash and fair value be obtained for assets that are sold, and that the cash proceeds are either reinvested in the business or used to delever the company. The affiliate transaction covenant is designed to ensure that transactions between the company and its shareholders or management are undertaken on arm's length terms, and to the extent that they're large enough, that arm's length nature is confirmed by an independent third party. The merger covenant is designed to ensure that if the company merges with a third party or transfers all or substantially all of its assets to a third party, the obligations in respect to the bonds follow the assets. The reports covenant is one that a lot of European issuers don't like very much. It requires typically quarterly financial information to be made available to investors and posted on a website, as well as audited year-end financial information. It also requires US-style MD&A, so a discussion of results of operations. In some cases, it requires interim reports of material corporate developments, which follows along the US reporting system. The more detailed the reporting, the less happy your European issuers generally are. So just very quickly, what do these covenants mean for the company on an ongoing basis? I've taken just a few examples. Acquisitions. Are these high-yield covenants likely to impact a company's ability to do an acquisition? The answer is no, if the acquisition is not funded with debt, and if the acquisition will result in the company owning a majority interest in the entity. There will be nothing in the indenture that precludes it. However, if the company is acquiring a company and funding it with debt, they'll need to ensure that they can incur $1 of debt under the debt covenant. If they are acquiring a minority interest, they'll need to ensure that they can make that investment under the restricted payments covenant. So they'll either need to have a carve-out or an exception, or they need to have sufficient accumulated net income to be able to make the investment. Debt incurrence. Yes, this will be significantly restricted by high yield covenants. That being said, as I said before, issuers are highly focused on ensuring that there are adequate ordinary course exceptions to the debt covenant to let them run their business as they would ordinarily run it. So working capital debt is typically permitted under a credit facility basket, obviously subject to a cap. Debt for capital expenditures is typically permitted under a separate basket, subject to a cap. Types of debt that are likely to be restricted by the covenant include acquisition debt and any debt incurred to fund a dividend. And this we'll come to a little bit later, but the second aspect of that makes undertaking a leverage recap somewhat difficult with high yield bonds in place. In terms of these two types of debt, the only place you're likely to be able to incur them is if your coverage ratio is adequate, if your general basket is adequate, and depending upon how your purchase money debt basket is drafted, you might be able to incur acquisition debt in that basket. Next is how are dividends restricted by these covenants? And the answer again is significantly. The only way you'll be able to pay a dividend typically is if your accumulated net income is adequate enough to do so. Minority investments, there's typically more flexibility for these than for dividends, as well as the 50% of consolidated net income permission. There are generally baskets for permitted investments. So to the extent that a company runs its business through joint ventures, it'll be important for the company to negotiate permissions to make ordinary course investments in joint ventures. This will be an area of focus in terms of negotiations. We can go, that's what we just talked about. Dispositions, how will they be impacted by covenants? The asset sale covenant is the covenant that's likely to impact that. In general, if a company is selling assets for cash and getting fair value, there will be very little impact of these covenants on its ability to make dispositions, as long as the cash is either used to reinvest in the business or to pay down debt. If a company is selling assets and taking back a note from the buyer, that will be restricted, and there are various ways to negotiate provisions in an indenture to deal with that. How do these covenants affect an exit? I guess I've divided the universe of exit into either a leverage recap or a sale of the business. The covenants will have absolutely no impact to the extent that there's an IPO, other than, well, depending upon where the proceeds go. But on a sale, it's almost a certainty that a change of control will occur. This will trigger your change of control covenant. I think the key issue here is that it is highly unlikely that anyone will buy a business understanding that this change of control covenant will be triggered without having resolved how they will refinance and take out the bonds. It's also highly likely that the high yield bonds can stay in place after the sale of the business, typically because they will be too restrictive to permit the acquisition finance that's required in connection with the sale of the business. Consequently, the way this covenant is typically dealt with is that either the buyer or the seller will undertake a tender offer, which is typically done at a make-whole premium at T+50, to get rid of the bonds, and in connection with that, they will strip all of the covenants in the bonds. So in reality, even though the change of control covenant exists, in most cases, the buyer or the seller will undertake a tender offer to get rid of the bonds because they won't be able to run their business or acquire the company without getting rid of them. In terms of leverage recaps, which obviously are on the rise, the debt test and the restricted payments test will impact a company's ability to undertake that. Certainly there's, I think, probably more flexibility in the debt test than there is in the restricted payments test to undertake a leverage recap. Generally speaking, a company's coverage ratio, EBITDA to interest expense, increases faster than its accumulated net income, just because of all the add-backs of non-cash items and one-time items to EBITDA. So, and there are also general baskets under which you could incur the debt to pay a dividend. The restricted payments basket is, as I said before, the likely restrictor of a leverage recap. The only way to pay a dividend is to have 50% of consolidated net income available for payment of the dividend. Consequently, I think if you're undertaking a significant leverage recap, you're likely to have to deal with your bondholders. I think Inmarsat was a recent deal which actually did pre-negotiate a small permission for a leverage recap. They built into their restricted payments the debt covenant, the ability to incur $100 million of debt in order to pay a dividend. It was subject to a number of restrictions, including that there be no ratings decline and that the leverage ratio not be diminished by virtue of it. That's, I think, an overview of the high yield covenants. And the last aspect of this was something that Simon touched on, which we'll go through again relatively quickly, which is bridge loans. In almost every deal where you have high yield, you will have a bridge loan that precedes it. And that is for a couple of reasons. The first is the necessity, either through market convention or through law, of getting to a position of certain funds. Etienne, if you want to just talk about certain funds.
Certain funds is actually something that really doesn't exist in the US at all. It's not a US practice, but it's, as many of you know, it's the idea that either because you're doing an LBO of a publicly listed company and you've got to show that you've got the funding in place to go through your IPO, sorry, your purchase, or in some of the larger deals, there's also a requirement by the seller to have a certain funds commitment by the purchaser, which is the assurance that, subject to rather fierce material adverse change clauses, the funding will be in place. And basically, as the high yield process is too involved, takes too long, quite often you will have an initial, you can't fund through senior plus high yield, so as we did on Le Grand, for example, you will fund through senior plus a bridge, which will then convert into, or will be refinanced through a high yield, or will stay in place, but at rather fierce conditions if you don't manage to refinance through high yield.
Sorry, go ahead.
No, and in terms of a lot of these, one of the aspects about the certain funds is that you've got to make sure that it is a real certain fund. It's obviously not a process you can go through when you have a lot of different banks offering funding to a lot of different potential bidders, because you don't have the time, you don't have the money to put in place sufficiently certain documentation to ensure that you've got a certain fund.
I think the other reason why we see bridge loans is because in most cases the level of disclosure required to undertake a high yield offering, particularly financial statements if you're carving out a business and buying a carved out business, just takes time, and it's not practicable to put together an offering memo together with all the relevant financial information for a capital markets offering in advance of actually closing an acquisition. So the net outcome is that bridges are a fact of life in European LBOs, and they actually get funded, unlike in the United States where they typically are not funded. In the United States, typically you get a bridge commitment and you get to market with a high yield deal before the deal actually closes. That's not true here. Quick overview of bridge loans. As Simon indicated, there are really two types of bridge loans. One is the US style bridge loan and one is a mezzanine style bridge loan. And we've just put together a chart here that really compares pure mezzanine to a US-style bridge, a mezz bridge, and the ultimate high yield. Again, as Simon mentioned, the real difference between a US-style bridge and a mezz-style bridge is that a mezz bridge will be designed to convert into syndicatable mezz at the end of a year. So the ultimate exit is through syndicatable mezz. The ultimate exit on a US-style bridge is through the high-yield market and exchange notes. So flipping quickly through these, in terms of the borrower on a bridge, a US-style bridge and a mezz bridge, typically the borrower will be a high-yield issuer and structurally subordinated. On a mezz bridge, the borrower will typically be the same as the borrower under the senior loan. Maturity of a US-style bridge versus a mezz bridge, typically both of them will have an initial maturity of 1 year and extend for an additional 9 years, sometimes subject to conditions and sometimes not. Interest on a US-style bridge is generally floating and increasing, and it will be capped. The caps right now, Simon, are they 12 and 14?
Bit
Sorry.
less.
A bit less. Where are they now?
11 and 12 or 13.
11 and 13. So
11 and
13%
12.
interest all in and 11% cash interest. In terms of the Mez bridge, interest will work the same way. We've already talked about the exit. US-style bridge is a bond exit. Mez-style bridge is the mezzanine market.
Thank you very much, Kay. Thank you, Etienne. And thank you, Simon.
Thanks
very
very
much.